Welcome to Accounting 201 at Kapiolani Community College. In this video, we'll talk about all of the tons and tons of information in Chapter 5. It's a lot of new information presented in a pretty quick format. First of all, there are many new accounts in use for Chapter 5. As the notes indicate in Item 1, we want to be able to tell what those accounts are and how they behave and what their characteristics are and so forth. So to do that, we have a little worksheet inside of our notes. It looks like this guy here. Sales account is one of our most important accounts. That's also known as sales revenue, and it has a credit balance, shows up on our income statement. And when you're making a journal entry for a sale of merchandise on account, you'll need 4 accounts, and also for sale for cash, same thing, 4 accounts. Next thing, sales returns and allowance is a contra revenue account. So that represents merchandise that got returned to us, or price breaks that we give our customers because of some flaw in the merchandise or something like that. Debit balance account because it's contra to normal revenues. Also on the income statement, you'd see it in an entry like this if we were only giving an allowance. If we were giving a return, we do an exact opposite entry from this one up above. Sales discounts, those are given to customers when they pay us within a special discount period that we've set up. And it's also a contra revenue account with a debit balance, shows up in the income statement, and you'll see it at the point where you actually collect the cash from the customer. Because they get to give this sales discount, the sales discount reduces the amount of cash you actually collect from the customer on their account receivable because it's a discount. Also, the inventory or merchandise inventory account, new account, it's an asset. Debit balance, you'll find that on the balance sheet. And here's an example of us purchasing merchandise on account. Cost of goods sold, another new account. This is like a mega expense account. You'll see it up on your income statement, way up near the top in a multiple step income statement, showing you how much was the cost of all the merchandise that you've given to your customers. It's treated like a large expense, special situation expense, has a debit balance, and you can find that on the income statement. So up here, for example, we see cost of goods sold and merchandise inventory being impacted whenever we make a sale entry. In addition, cost of goods sold is the go-to account for making adjustments for your inventory account. So say your system tells you how much inventory you're supposed to have, but you count it and it's not that same amount, then you'll either debit or credit cost of goods sold and the inverse to merchandise inventory in order to adjust your inventory to what it ought to be. So cost of goods sold is a frequently used account. Last one, freight out or delivery expense. This is for the cost of freight that we send to our customers when it's our responsibility to pay the freight. And that's an expense account with a debit balance, and you find that also on the income statement. So you can think of this sheet as kind of like a crib sheet for all the new accounts that you're encountering in Chapter 5. So one of the biggest things we have to do is make journal entries for a company that sells merchandise, and it's a 2-step process because they, instead of just providing a service for the customer, they purchase the merchandise, they stock it, hold on to it until customers buy it, and then they either give directly or deliver to the customer. So the transactions are more complex than they were back in chapters 1 through 4, service business. One of the first things is we're using a perpetual inventory system. That means we're perpetually or always keeping track of our inventory. So all of our merchandise, we're supposed to know how much we have on hand at any one point in time. Additionally, in business-to-business transactions, there are typically discount terms given between the businesses. So there are 2 kinds of discounts you can hear about, major ones. Cash discounts are discounts that you get or give for paying promptly, amounts due on account. Trade discounts are based on who the buyer is within the distribution chain. So you may say you have a large discount because you're buying directly from the factory and you'll be reselling to retailers. That would be a trade discount. If you get a small discount, 1, 2, 3% for paying quickly within a short period of time, then that would be called a cash discount. Now, common discount terms look like this guy here. This is read 210 net 30. That would be how you'd say the discount terms, and it means if you pay or within 10 days of the date of sale, you will get a 2% discount. Otherwise, you have to pay the whole amount within 30 days. So if we're paying 20 days earlier, you receive a 2% discount. This comes out to, and your book shows a computation, something like about a 36% rate of interest on your money. So it's obviously a super good policy to always take discounts when they're available to you. Now, you should expect to see, of these 8 transactions I'm going to show you, you should expect to see 6 of them on an exam, and that means you really need to know them well. So first one, purchase merchandise on account. We'll debit merchandise inventory or the inventory account for whatever the total cost of the merchandise was, and credit accounts payable. Now, if we return some of that merchandise to the vendor, we'll debit accounts payable to reduce it for the amount returned, and credit merchandise inventory to reduce that for the amount returned. Then if we go ahead and pay the balance within the discount period, the amount accounts payable will amount to however much it is we still owe after the return. Merchandise inventory will pick up the amount of our discount for paying within the discount period, and cash will be the remainder. Accounts payable minus the merchandise inventory discount is cash. Now on the flip side, when we sell merchandise, the journal entries are much more complex than they were in earlier chapters. Now we'll have 4 accounts involved in every sales transaction. If it's a sale of merchandise on account instead of cash, the debit will be to accounts receivable, credit will be to sales or sales revenue. Then we also have to debit cost of goods sold and credit merchandise inventory or inventory for the dollar amount of our cost of that merchandise. So selling price at the top, cost below. If the customer returns some of that merchandise to us, we'll basically flip the journal entry around and change sales to sales returns and allowances. So that means every account involved here, sales returns and allowances getting larger, accounts receivable getting smaller, merchandise inventory going back up again because as the merchandise comes back into stock, cost of goods sold going down. Now if we pay within the discount period, 3 accounts again, except things kind of turn around a little bit. We'll be receiving cash, so first we want to look at how much the receivable is after having customer having made the return. Next, we'll look at the discount amount, and we have a specialized account for this called sales discounts. That'll be the up 2% of whatever the discount terms are on the account receivable, and then cash will be last. So the account receivable less the sales discounts will equal the cash. So there's some special accounts that we have here and their relationship to sales and purchase. I kind of want to recap it for you here. If we're talking about returns or discounts or shipping, then the very unequal treatment between purchase side and sales side. On the purchase side, you just use the inventory account for every single return or discount or shipping cost. But on the sales side, you have customized accounts that say what it is you're doing. So sales returns and allowance, sales discounts, freight out or delivery expense. We don't have purchase returns and allowances. We don't have purchase discounts, and we don't have freight in. So for those, we just use inventory. Shipping terms are a special situation in a merchandising company where the freight cost and the title and the risk of loss for that merchandise changes hands at one place or another. When we're talking about cutoff procedures, we're trying to figure out a way to systematically make sure that we get the right purchases and sales in the proper periods. So if we have shipping terms that's say we have FOB shipping point sales, that means as soon as we put it on a commercial carrier, some kind of a freight company, truck or ship or whatever, then it's no longer our merchandise. It's gone to the customer. They've bought it at that point in time, even though they haven't received it yet. Conversely, if we sell stuff FOB destination, then we haven't made a sale until the customer actually gets it, and then they make their purchase right at the point where they actually receive it instead of at the shipping point. So if you have stuff that's on its way between the two parties, like it's on a common carrier, a ship, a plane, train, whatever, then it's going to work out like this. If the item was sold FOB shipping point or purchased FOB shipping point, then while it's out there on the ocean, the title to it is going to be the buyer's because they bought it as soon as it got shipped. And they need to have insurance on it, and they're going to have to pick up the freight cost. On the other hand, if the item is sold FOB destination, then the seller maintains ownership of it all the way until it reaches the destination. And if it gets lost or damaged in transit, that's the seller's responsibility to have insurance on it, and the freight costs are also paid by the seller. Now, we put all this information together, and we'll see we have a new kind of an income statement that we never had before. Before it was just revenues minus expenses equals net income. Now we have multiple steps we're going to go through as we compute net income. First, sales minus sales returns allowances minus sales discounts will equal net sales. Then we'll get our cost of goods sold and subtract that, and that'll give us something called gross profit. So net sales and gross profit, new subtotals you've never seen before. We'll include our operating expenses next, which are all of our other mostly all of our other expenses except for cost of goods sold. And we'll get something called income from operations. Then we have some specialized accounts that belong in other revenues and gains and other expenses and losses. Prime among these would be anything with the word beginning with the word interest, interest revenue or interest expense, belong under other revenues and gains or other expenses and losses. And then also anything that begins with the word gain or loss. Those belong in other revenues and gains, other expenses and losses. Finally, we add the other revenues and gains, subtract the other expenses and losses, we get net income. You'll have a quiz over this, although you'll need the dollar signs and the titles at the top and the computations and details under the other revenues and gains, other expenses and losses section. Last thing, when we're talking about a merchandising business, we have a worksheet that we're going to use to speed up preparation of our financial statement and a bunch of new accounts that we didn't have before. First of them is inventory or merchandise inventory. That's a balance sheet account. You'll find it in the debit balance of the balance sheet in a worksheet for a merchandising business. And then we proceed to go through all of the accounts that are involved on the income statement. So sales, credit balance account on the income statement of the worksheet. Sales returns and allowance, sales discount, cost of goods sold, freight out, operating expenses, all of those are debit balances on the income statement column of a worksheet. Other revenues and gains, back to the credit side, still income statement. Other expenses and losses, debit side, still income statement. So special new accounts, almost all of them except for inventory, go on the income statement. When you do the closing entries for a merchandising business, I won't test you on this, but you should know what you're going to be getting done. First thing is you're going to get rid of all your income statement accounts that have credit balances, drop them into income summary. Then you're going to close out all your income statement accounts that have debit balances to income summary. And last, close income summary into retained earnings, and then finally close your dividends into retained earnings, just like you would have under a service business. So it's a 1-2-1-2 punch apparently. Last thing, inventory systems. There is another way of keeping track of our inventory. We're assuming a perpetual inventory system, but there is such a thing as a periodic inventory system. It's looser controls and tends to be used with items with less cost per item. And all you really do is you record purchases as you make them in a purchases account. You record sales as you make them without trying to take it out of inventory. So the procedures while recording transactions involving inventory are kind of slimmed down. And at the end of the year, though, you have to go out and count your inventory to determine how much inventory you actually still have. At that point, you adjust your inventory account to what the new dollar amount should be, and you produce the dollar amount of cost of goods sold. So you don't really know your inventory, you don't really know your cost of goods sold as you go throughout the year. That's in contrast to a perpetual inventory system where you always know your inventory and cost of goods sold because you've been tracking it all along. So new accounts would be for this periodic system, purchases, and if you have returns, you would have purchase returns and allowances. If you receive discounts, you'd get purchase discounts. If you had freight on incoming merchandise, you'd use a freight in account. All of these accounts you do not have in a perpetual inventory system, but do have in a periodic inventory system. Last, when you make a sale, you'll debit cash or accounts receivable and credit sales, and that's it. No recording of cost of goods sold. Now, when we look at our gross profit on our income statement, that gross profit should bear some kind of generally a consistent relationship to the sales. So if you take your gross profit rate a gross profit amount, and divide it by your net sales, you get what's called the gross profit rate. And companies watch this thing very, very, very closely, to the point where if there's a 0.1% drop in the gross profit rate, they're all scrambling around trying to figure out like how to keep that from happening again. So the gross profit rate, a very closely watched metric or measurement used for companies that sell merchandise, and they really want to know that that thing is either stable or increasing over time. Thanks, hope this helped. Let's dive a little bit more deeply into the details of a multiple step income statement. First of all, in the top part of the statement, you'll have the name of the company, the title of the statement, and the period of time ended on a particular date. You start out calling out sales and subtract sales returns and allowances and sales discounts to arrive at net sales. Then you subtract cost of goods sold and you get gross profit. So that, as I indicated, is a pretty important term. And following gross profit, you'll list all of your operating expenses, or you may just have a one line item that indicates the total of operating expenses. For example, operating expenses $114,000. Following that, you'll get a subtotal called income from operations. Income from operations is gross profit minus operating expenses. Now, following income from operations, you're going to dive into your non-operating activities. These are things that had an impact on our net income, but they're not really in our main business activity. So we segregate them down here in this lower section to indicate just that. First category, other revenues and gains. Interest revenue, if we have it, will always be here. Interest revenue or income or interest earned. And anything that starts with the word gain. So in this case, getting rid of planned assets. Now, why is it here and not up here? It's because we don't normally try to sell our planned assets, and financing our business is not an investment, is not really one of our main business activities. So we've segregated these guys down under other revenues and gains. Other expenses and losses. Interest expense, if we have it, will always be here, and anything that contains the word loss or typically starts with the word loss, like loss from any of these things here. These are not exhaustive list of possible gains or losses, but there are some very common ones. So last we arrive at net income. So remember, it's sales minus sales returns allowance and sales discounts gives me net sales minus cost of goods sold equals gross profit minus operating expenses equals income from operations plus other revenues and gains minus other expenses and losses equals net income. You can see the net income amount for a company, not that company, here on the company's worksheet. So, shoots back. Crap. And in their worksheet, you'll see the new accounts that we have in this chapter. There's a situation here with a credit to inventory. Our inventory must have been about $500 more than what, showing $500 more than what's really on hand. So we adjusted it down by 500 and put the difference into cost of goods sold. So it went from 40,500 down to 40,000. Notice we also have sales revenue, and contra to that, sales returns and allowance, sales discount, and cost of goods sold. And then all of our operating expenses are listed under here, as well as some that came about by adjustment over here. And as previously, we total up the income statement pair of columns and get a debit or a credit difference, drop it in under the short side, and same with the balance sheet. If we wanted to talk more about sales of merchandise and the two types of systems that there are, we're assuming a perpetual inventory system. So everything is hardwired directly into inventory. You make purchases for cash or on account. You have purchase returns. You have freight costs. All of those things go straight in inventory. And if you pay within a discount period, the discount comes out of inventory. In a periodic inventory system, you have inventory, but you only adjust it once a year. So most of your transactions use the purchases account. Also, separate account for freight in, in a periodic inventory system, and in a periodic inventory system, purchase returns and allowances is an actual account, as is purchase discounts. And when we're looking at the sales of the merchandise, our standard entries here with accounts receivable, sales, cost of goods sold, and inventory are matched by just the accounts receivable and sales portion in a periodic inventory system. No entry for the cost of goods sold. And if we have a return of merchandise from our customer, we'll debit sales returns and allowances and credit accounts receivable and do nothing to pick up the inventory and cost of goods sold difference. Last, when we receive within the discount period, that tends to look exactly the same as it does under perpetual inventory system. But mostly all of the other entries for purchases and sales of merchandise on account, or for cash and for freight and for returns and allowances, are very different between a periodic system and a perpetual inventory system. Hope this helps.